Okay, if you're ignoring the storm brewing around MicroStrategy, you are seriously risking getting wiped out by a potential multi-billion-dollar sell-off. Now, for years, everyone believed that the company's constant buying was the ultimate safety net for Bitcoin. But what if the data, and we're looking at a new crypto global news analysis here, shows their purchases have a, well, statistically insignificant impact on the price? So, over the next few minutes, we're going to break down the two massive threats that could force Bitcoin's greatest champion to become its absolute biggest villain. And we'll reveal the surprising data that shows why Bitcoin might actually be stronger without its hero. All right, let's start with the sheer scale of this bet. 649,870. That's how many Bitcoin one single company, MicroStrategy, is sitting on. I mean, to put that into perspective, that's over 3% of all the Bitcoin that will ever exist. It's just a colossal position. To really get the risk here, we first have to understand how on earth they built this massive position. You see, it wasn't just simple buying. It was this unique financial mechanism that basically turned them into a backstop for the entire industry. For years, MicroStrategy was powered by something a lot of people called the infinite money glitch. It all boils down to their MNAV premium. So what does that mean? It just means investors were so hungry for Bitcoin exposure through the stock market that they would pay more for MicroStrategy's stock than the Bitcoin it actually held. This premium, well, it was basically free cash that the company could then turn around and use to buy even more Bitcoin. And this just illustrates perfectly how that glitch worked. It was a brilliant flywheel. They'd issue their stock at that high premium, use the cash to gobble up more Bitcoin, which, of course, increased the amount of Bitcoin per share. The market absolutely loved this, so the stock price would shoot up, the premium would get even bigger, and they could just rinse and repeat over and over again. But that beautiful flywheel has ground to a halt. And now there are two massive threats looming on the horizon that could throw this entire strategy into a really dangerous reverse. So, threat number one, it sounds kind of boring, it's a bureaucratic one, but trust me, it could be devastating. It comes from a company called MSCI. Now, these are the folks who decide which companies get included in these massive global stock indices. We're talking indices tracked by trillions of dollars in passive investment funds that just buy whatever's on the list, no questions asked. Right now, MSCI is deciding whether to kick out what they're calling digital asset treasury companies. The final decision is set to drop on January 15th, 2026, and you can bet the market is holding its breath. It is a total coin flip event with billions and billions of dollars hanging in the balance. Now, the second threat is way more immediate. It's the total collapse of their stock premium. For the first time since all the way back in August 2020, MicroStrategy's stock is actually trading for less than the value of the Bitcoin it holds. The infinite money glitch, it has officially been turned off. And this slide just lays out exactly what that means. You see, back when their MNAV was greater than 1, selling stock was accretive. It was actually profitable for them. But now that it's below 1, selling stock is dilutive. It actively hurts their shareholders. So the bottom line is this: the buying machine is off. And it's off at the exact moment their cash reserves are starting to look pretty thin. So what happens if MSCI actually gives them the boot? Well, the fallout could be mechanical, it could be brutal, and it could create a really vicious negative cycle. Some analysis shows that an MSCI exclusion alone could trigger about $2.8 billion in forced automatic selling from all those passive funds. And if other index providers decide to follow suit, that number could balloon to a staggering $8.8 billion. And what this does is create the exact opposite of that beautiful flywheel we talked about earlier. A crash in MSTR stock would put huge pressure on the Bitcoin market, dragging the price of BTC down with it. That, in turn, further slashes the value of MicroStrategy's assets, putting even more pressure on their stock. It's a classic, dangerous, downward spiral. Okay, so it sounds like a catastrophe is basically a sure thing. But hold on. Before the fear, uncertainty, and doubt, the FUD, really sets in, let's look at the data, because it tells a very different, much more resilient story. The man himself, Michael Saylor, has come out and explicitly denied any plans to sell. But you know what? Forget his words for a second. The company's actual financial structure is surprisingly robust against a forced sale. Their defense is actually a brilliantly structured wall of debt. Get this. No major debt comes due until 2027 at the absolute earliest. There are no margin calls.
Bitcoin's price would have to crash to around $3,000 before any real liquidation pressure would even start to kick in. And look, if things got really dire, Saylor's board could just suspend dividend payments to avoid selling.
All right, so a forced fire sale seems pretty unlikely. But that just brings up another huge question, right? Has Bitcoin's price been artificially propped up this whole time by their constant, relentless buying? I mean, what happens if that buying pressure just vanishes? And this is where the data from that crypto global news analysis gets really surprising. I mean, I honestly had to double check this number. It shows that MicroStrategy's purchases have historically averaged just 3.3% of the total weekly trading volume for Bitcoin. Let that sink in for a second. Just 3.3%. The data confirms this. On a scale where 1 means a perfect connection, the statistical link between their buying and Bitcoin's price is less than 0.3. So in other words, their purchases don't reliably predict a price increase. Yeah, they might be a massive whale, but as the data clearly shows, they are not the ocean. And all this brings us to the final verdict on Bitcoin's market structure. You have to ask, has the market simply outgrown its biggest buyer? Look, the market today is just fundamentally different than it was back in 2020. We now have spot Bitcoin ETFs that provide new, super easy ways for big institutions to invest. We have other major corporations holding Bitcoin on their balance sheets, and we even have nation-states like El Salvador adopting it. This isn't a one-company show anymore. What we're seeing is the decentralization of institutional buying, and that's a huge sign the market is maturing. So what you should really take away from all this is a pretty clear distinction. The short-term risk for MicroStrategy stock is very, very real, and it could get highly volatile. But for the Bitcoin market itself, this whole uncoupling might actually be a healthy thing in the long run. It removes what you could call a potential single point of failure. And this is a great way to think about it. MicroStrategy was the training wheels for institutional adoption. They broke the ice, they proved it could be done, and they showed Wall Street that it was possible. But now, Bitcoin might finally be ready to ride on its own. Which leaves us with one final, pretty provocative thought. Is this whole situation a crisis for Bitcoin, or is it the final necessary step in its evolution into a truly decentralized, resilient global asset? The answer to that question could very well define the next chapter for this entire market.
Stay ahead in the crypto market. Subscribe now for the latest global news and updates.